Good morning, everyone. Well, the FOMC meeting went as expected and had almost no impact on trading. The Fed said that underlying strength in the economy was improving. We'll learn more about this later today when the flash estimate of fourth quarter GDP comes out. It's expected to show an annualized rise of 3.2%. That's a drop from 4.1% in the third quarter. Private sector demand is expected to be healthy, but this will be partly offset by a fall in federal spending, naturally, because of the government shutdown. Investors may therefore ignore the decline in the headline, and strong private sector demand could support the dollar, even if the headline figure shows a slowdown. The Reserve Bank of New Zealand also kept its interest rates unchanged overnight, but that pushed the New Zealand dollar lower as the market had been pricing in about a 50-50 chance that they'd hike. Furthermore, the absence of any hint that they were likely to hike at the March meeting disappointed some investors. I think a hike is likely, or at least the possibility of a hike is likely. More can be said for many markets, and recommend that investors consider buying the New Zealand dollar on dips. In this context, I'm still bearish on the Aussie Kiwi following this morning's downward revision in the final HSBC market China manufacturing PMI for January. I think the Aussie is more vulnerable to a slowdown in China than the Kiwi, and so the Kiwi should continue to gain on the Aussie dollar. The next clue will be on Saturday when the official Chinese manufacturing PMI for January will be announced. Although it's forecast to remain over 50 in expansionary territory, nonetheless, it's also expected to fall to a 7-month low. That might provide another downward push to the Aussie dollar. The main story overnight, though, wasn't in the G10 currencies, but rather in the emerging markets world. EM currencies continued to sell off despite, or perhaps because of, the South African Reserve Bank's surprise 50 basis point rate hike yesterday. In fact, the South African rand was far and away the worst performing currency overnight. Their rate hike demonstrates the really poor trade-off that EM countries face with the Fed tapering. They can either let their currencies go and face higher inflation and lower purchasing power internationally, or they can raise the rates and stifle growth. Now, with funds just now starting to flee emerging market stock markets, this crisis is just beginning, in my view. It has further to go, and these EM currencies have further to fall. On the other hand, the heightened tensions in emerging markets and thoughts of global monetary tightening sent the safe haven yen and Swiss franc higher. Although I'm bearish on these currencies in the medium term, they could appreciate further for the time being as investors continue to cut their emerging market positions. During 2011, there was a very close correlation between EM turmoil, as measured by the EM VIX index, and dollar-yen. As for today's indicators, the German preliminary CPI is forecast to accelerate slightly in January. That could take some pressure off the ECB to ease and therefore be euro positive. Otherwise, in the U.S., along with the GDP data, we have the weekly initial jobless claims. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.